Zsolt Darvas, economists have been warning Germany for some time, and EU Commissioner Olli Rehn has also singled out the country's current account surplus and the concern that an export-driven Germany economy is holding back growth in southern Eurozone countries. Why has it become such a public concern now? What are the numbers telling us?
The issue came to the headline following the late October report by the US Treasury on international economic policies and exchange rates, because the US Treasury accused Germany for maintaining a too high current account surplus and thereby pushing the Eurozone, but also the rest of the world, to a deflationary spiral. Germany's current account surplus was the largest in the world in nominal terms last year. So Germany's surplus was even larger than the surplus of China. As a share of GDP, it's also very high. Last year it was 7%, and according to the latest forecast by the European Commission, it will be over 6% in the coming years, and 6% is a threshold for current account surpluses to enter an excessive imbalances procedure.
So what's behind Germany's trade surplus?
Now, German politicians argue that there is a demand for quality German products, but if you look at the data in a bit more detail, this claim is itself not sufficient to explain the German surplus. I did a very simple exercise. I looked at German trade with respect to 3 geographical partners: the Euro area, the 10 other countries in the EU which are not members of the Euro area, and all countries of the world. And what we can see is that now most of the surplus is coming from trade with countries outside the European Union. And if you look at developments during the past few years, we saw a very rapid increase in German exports to non-EU countries, but at the same time, a fall in German imports from the non-European Union countries. So this suggests that, yes, there is a demand for quality German product, that's correct, but at the same time, there is no demand from Germany for products from outside the world, and this has led to a major increase in the trade surplus of Germany with non-EU countries. And I think the criticism is correct. Germany has to reduce its trade surplus.
What measures can Berlin take, though, to address internal demand?
That's the most difficult question, because I think there is a widespread consensus that domestic demand is weak in Germany. For example, last year domestic demand has fallen. This year the Commission expects less than 1% growth in domestic demand in Germany, which is too slow. Now, one option is fiscal policy. So I think the best would be for giving tax breaks for investment, because investment rates in Germany, private investment rates, are very, very low for now many years. But if companies would be able to get tax breaks, they may perhaps invest more, and there is more investment, there is more demand. The second issue is more public investment, because if you also look at the investment rate of the public sector in Germany, this is one of the lowest in the Euro area. And I mean, the German public sector has a very healthy balance sheet. It can borrow at a very low interest rate. Even the real interest rate is close to 0 or even negative, meaning that, you know, the nominal interest that Germany has to pay is lower than the inflation in Germany. And this means that, you know, any investment made by the public sector which has a non-zero return, positive return, would be profitable. So I think boosting both private and public investment would be the right way to go for Germany.
And what would be the immediate repercussions of Germany not heeding these international warnings? Berlin seems quite reluctant.
Yeah, the major problem is that overall demand in the Euro area is very weak. Now, one manifestation of this weak demand is a very low inflation. I mean, the most recent inflationary figure for October suggested that inflation in the Euro area is as low as 0.7%. The core inflation, from which the impact of energy and food prices is excluded, is also below 1%. So clearly the Euro area is going toward a very low inflationary environment, which is really dangerous, because there has to be a relative price adjustment between surplus countries like Germany and deficit countries like Italy and Spain. And if the overinflation is very low, then this means that inflation in Southern Europe will have to be even negative, so they will even need deflation. But if countries in Southern Europe have deflation, it will worsen public debt sustainability because it increases the real value of debt. And we know that both public and private debts are very high in Southern Europe, so indeed they should avoid by all means a deflationary period.